For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Welcome. Thank you once again. Back in studio. It's just you and me, Professor Rick Plum.
This time, yes.
That's right. Certified Financial Planner, Professional, CFP Professional. I'm Johnny Dean, your podcast host, and not an advisor, but hanging out with a bunch of them. We're, again, working on, I think we might have Joe P. Lucia on in the next week or two. I've got Ara Friedman.
Ara?
Yep.
MBA, CFPs.
All that stuff. I don't know.
I don't think he's sat for the test yet. He's taken all the exams. He's ready for it.
Yes, but we've got topics. Ready. We've got topics coming up on that. So anyway, like 3 or 4 more episodes left in this season before we take a couple weeks, and then we're back for the next season. So it's just cranking right along. Today's topic, it's interesting to find out, as I was looking through some research here, that said that many people, in fact, I think it was a majority, depending on what you look at, did not know that their Social Security benefits could be taxed.
It is, and more people are having their Social Security fall into the tax column every year.
Well, we are. In fact, I think with the raise, what was the raise
like
for 2023? Yeah, I don't have it here, but
it was almost 9% for the COLA increase for 2023. So people saw their benefits increase quite a bit. And they got to keep all of the benefit increase because Medicare actually went down $5.
Yeah. How about that? The Medicare premium. I don't know when that's going to happen again. If? Has it ever happened?
I've never I haven't looked back that far.
Well, so I think what's happening for some people is the income thresholds are staying the same.
Right. The idea of the taxability of the Social Security benefit, there's a lot of misconceptions around there. One of them is that it's age related, and that if you reach a certain age, then none of your Social Security will be taxable. That is not a true statement. Social Security taxability doesn't care what age you are. Doesn't care whether you're receiving a retirement benefit, a survivor benefit, a family benefit, a disability benefit. They don't care what kind of benefit you're receiving. If you're receiving some form of benefit from Social Security and your income has certain characteristics, some up to as much as 85% of your Social Security benefit, the gross amount of Social Security benefit, not necessarily what's being deposited into your bank account, the amount that you're paid before the Medicare deduction, up to 85% of it could be taxable.
So let's talk for just a moment about what causes your Social Security to be taxed in the first place. What goes into the formula to determine whether or not it's going to be your Social Security benefits are going to be taxed?
Pretty much everything that shows up on the tax return. If it is on your tax return in the taxable column and or it's in that tax-free municipal bond interest area, add all that up, and the higher that number goes, the more potential tax you will pay on your Social Security benefit. Now, they set the thresholds. What the formula basically says, take a look at all the income you have, your capital gains, your net capital gains after the $3,000, you can't go more than $3,000 negative on a capital gain in a given year, capital loss. Your net rental income, your pensions, your IRAs, your wages if you have them, or your spouse or anybody else on the tax. Look at everything on the tax return.
Is this just kind of your combined AGI or what?
Well, it's not AGI yet. This is a modified AGI, and you have to do this calculation before you can find your true adjusted gross income, because adjusted gross income includes the taxable amount of your Social Security. We don't know that number yet. So we have to look at all these other numbers, add up everything, and then add half of the Social Security that you've been paid for the year. That is your modified adjusted gross income for the Social Security calculation.
Now, the Social Security you've been paid for the year, but as you were saying, it's not the necessarily what
before the
wound
Medicare
up in
premium,
your bank.
Before the Medicare premium. So you take, that's your provisional income. They call it lots of different things, but all your income, including municipal bond interest, plus half of the Social Security, now you have a number. Now you compare that number to a couple of thresholds. One of the thresholds was set in 1983 and hasn't changed since then for no COLAs, no increases. It's been the same number since 1983. The second threshold was set in 1993. It also has not changed since 1993. No COLAs, no increases, no adjustments for
Nope.
any inflation or anything. So back then, not as many people had incomes that exceeded the threshold. Now, Social Security by itself is getting larger, plus IRA distributions, everything. More and more people are falling into this trap of having to pay tax on their Social Security. And it's different for everybody. You may have forget the tax side of it. You may have a household income of, say, $70,000. And your taxability will be dramatically different depending upon how much of that $70,000 is coming from Social Security or other assets or other incomes. Somebody who has a combined, maybe a husband and wife has a combined $50,000 of Social Security, and then they're taking $20,000 from their IRA, they're going to pay no income taxes on that $70,000 of income. Somebody who has $20,000 of income and $50,000 of IRA and pensions are going to pay tax on 85% of their Social Security and quite a bit of their other income because of the way it falls in. Same gross income, very different tax situation. So how you play it out, and that comes to the point where if you know how the numbers work and they come down into the tax return, you may have the ability to adjust certain things.
Manipulate? Maybe?
Yes, that's a good word for this.
Yeah,
when it comes to taxes, we're okay manipulating income for taxes. As long as it's legal, we're not doing anything illegal. No, I had this discussion the other day. Somebody said something about tax evasion. I said, no, tax evasion's illegal. Tax avoidance is what we're going to work for.
We've used that analogy all the time of driving on the toll roads.
Right.
You can if you drive on a toll road, if you want to avoid the tax, you take another route. Right. And you don't go on the toll road.
You just don't blow through
if you crash the gate doing 98. And that's called tax evasion, right?
Yeah. So the idea is looking at where your cash flow, your income is coming from. Now, if you've got $10,000 a month of pension, okay, if you have Social Security as well, you're going to pay tax on it. There's not a lot you can do because you can't change that pension. Mm-hmm. But if you're taking distributions from your portfolio, you're taking $30,000, $40,000, $50,000 a year out of your portfolio. Where that distribution has come from could have an impact. Now, if 100% of your money is IRA and you need that 30, 40,000, whatever the number is, you don't have a lot of wiggle room. But if you have personal money, Roth money, and traditional IRA, you can mix and match where that cash flow is coming from and have an impact on your potential taxes and your Social Security. Obviously, we have to take into consideration what the ultimate required minimum distribution will be at age 73. Ultimately 75 for some people.
Right.
But it's all a matter of that little puzzle, putting the pieces of the puzzle in the right place to try to help you with the expenses that you don't like paying, taxes, and get you that cash flow that you do want.
It's funny how this all blends together. A few episodes back, I don't remember, we were talking about the different pools of money that people often have. You have pre-tax money in the form of maybe a 401k, right? Which when comes out, 100% taxable at ordinary income rates. Maybe you've got some personal money, a brokerage account somewhere.
You inherited some money.
Or, money in your savings account, whatever it is, personal money, which may or may not be taxable. And then you have Roth money potentially, which is, if you do it correctly, tax-free. These are generally the three types of accounts that people can have.
Yes.
And so if you're taking your income, as we said, from any one of those sources, you can take more from one, less from another. Right. And that's when you're talking about manipulating your income, Professor Plum. I think that's what we're talking about.
Right, because if I have a bucket number one, what we call, those are the safer, and most people are using very safe investments like treasuries at this point that mature each year, that give them the cash flow that they want. If that money is in an IRA, obviously any distribution from the IRA is going to be taxable. But if I have $500,000, just making easy math up here,
sure,
and I'm going to be taking $80,000 a year of cash flow from that pool.
Wow,
it's going to last a little while, 5, 6 years, 7 years. But how much do I have to pay in taxes if that's my personal money? And right now, a T-bill could probably earn a little over 4%, so $500,000. You earn $20,000 on that. Mm-hmm. I took $80,000 out. 20 of it was earning, 60 of it was principal. So the only thing that goes on my tax return at that point is $20,000, even though I had $60,000 or $80,000 of cash flow. So that had a big impact on the potential taxes I had to pay versus taking that entire 80 out of an IRA. So that would be all taxable.
Well,
so maybe you blend it, you take 40 and 40, and and so you play with the numbers and you get your cash flow and your taxability of those cash flows in a position that makes sense for you today and going into the future.
So how does somebody avoid this though? They're saying, look, I've got I have a Roth, I have 401k, I've got personal money, I've got all these different things, but I've got Social Security now. Social Security has just started for me, or it's about to start, and I'm concerned that I'm going to lose some of that to taxation.
Right. So
what can we do?
First off, you have to know where you are today. What is the impact happening today? Should you be taking your Social Security now, or should you be postponing it until as late as age 70? In the meantime, living off of the IRA, which obviously if you've postponed taking your Social Security until 70 and you're taking more money out of the IRA, that doesn't impact your Social Security taxability at all because you're not taking the Social Security yet, and you're drawing your IRA down, so that'll help with the required minimum distribution in the future, and you can then blend in things in the future so that you don't have as big of a distribution, and then when you do take your Social Security, you're getting some from the IRA, some from your personal accounts, some from the Roth accounts, whatever the case, but you're keeping your taxability in a little bit different area. But you have a true tax bracket today of maybe that 12% bracket versus, taking out $10,000 from your IRA when you're taking your Social Security and having to pay tax. You're still in the 12% bracket, but now I'm paying tax on $18,500 instead of just the $10,000 that came out, because I'm paying tax on the 10, but I'm also paying tax on $8,500 of Social Security, 85%, that I wasn't paying before. So understanding that little situation there.
All right.
Doing that, or in the meantime, doing some Roth conversions before you get to your Social Security age, or maybe you started one Social Security, the lower spouse starts taking their Social Security early, the higher wage spouse is going to wait a little while. Start doing Roth conversions up to the tax brackets that you can use and get money out of the IRA into a Roth IRA so you can start blending at some point in the future.
So when you talk about potentially having your Social Security taxed, you're going to look at, as you said before, half of your Social Security, right? Half of your gross.
Right,
and then it's pretty much all of your other income
on the tax return.
On the tax return. You said Roth. Roth, of course, as you're saying,
does qualified Roth distribution does not show up on the tax return.
So if you want to avoid taxes on your Social Security, would you say
have everything in Roth?
It's much better to have everything in a Roth, or maybe have as little as possible coming out of, let's say, an IRA, which is fully taxable at ordinary income rates, right. Or is it both?
It's combinations of those. And, when we talk about the Roth, sure, if I'm at retirement and I had a choice of, picking, okay, Rick, you can have $1 million in one of these three accounts. What's behind door number 1, door number 2, door number 3? You can have traditional IRA for $1 million. You can have personal money invested for $1 million, or you can have a Roth IRA for $1 million. And we're going to say it's qualified, so you don't have to worry about taxes. Of course, I'm going to choose the Roth IRA at that point because it's tax-free.
Sure.
Even the earnings, everything's tax-free. That's better than those other two options. But the question is, how do nobody's just offering me that type of an account.
No, you've probably got a bunch in an IRA, 401k.
I have to build it up. And so what is the cost of building that Roth IRA? I have to take that into consideration. What is it costing me, to convert my IRA rollover to Roth? Am I hurting myself that way versus what it's going to cost me in the future?
Mm-hmm.
Of course, I have to know what those numbers are to be able to tell how much pain I'm willing to suffer. Suffer today, suffer later. And it all depends on you. Where are you right now? If you're getting a late start, maybe you've been doing other things and finally you get into your late 40s, 50s, and you get a job that's making beaucoup bucks. I mean, you're up there. You're in the 300-400 or more, or whatever, and you're paying 32% or more in taxes today. Well, that tax deduction on the 401k is still probably a better deal than building a Roth at this moment, because you're in a really high bracket. You're getting a late start. You're not going to have $42 million in your IRA.
So you're saying don't go willy-nilly into this and try to.
Yeah. You have to understand where the cost and the benefit is and where you are in your situation.
But as a good rule of thumb, the more you have in a Roth, if you're trying to keep your Social Security out of the taxable
having money coming from a Roth on a qualified distribution, 5 years and age 59 and a half, doesn't affect, has absolutely no impact. I get the cash flow and no tax consequence.
Now, it's
I
good.
like that. And no tax consequence on the Social Security either.
Yeah, exactly, because it doesn't wind up on your tax return. There's a lot of good to the Roth. But what you said was, that's all well and good, but how do you get the money into the Roth?
What did it cost me to get the money into the Roth? If I can put it in, similar or lower bracket today than I'll be in retirement. Like if I'm in the 12% bracket right now, and when I retire, I'm going to have some pensions distribution. I'm going to be in the 12% bracket in retirement. I'm going to do Roth, because the reality is it's not a true 12%, because if I'm taking money out of the IRA and it's affecting my Social Security, sure, I'm in the 12%. But like I said before, I'm paying 12% on more than $1. I'm paying a 12% on the dollar I took out of the IRA and up to 85 cents of a dollar on the Social Security. So it becomes basically a 20% cost.
Well, and here's where you see the surprises hit with the Social Security taxation. You have somebody who's maybe managed pretty well. A good portion of their income has been Social Security and maybe some personal or Roth money, but they haven't touched their IRA, and they haven't.
Well, they've been
to.
reading the journalists on all the different websites. Don't touch your IRA until you're required to by the IRS. So live off your personal money until you don't have any, or until you're mandated to take required minimum distributions.
So they start their benefits at 66 or something like that, and
when they retire,
and they retire whenever they retire, and they say, "Oh, this is good.
I'm living fat on the hog. I got no taxes to deal with because I've got my family, got my $50,000-$60,000 combined between both husband and wife working, had decent benefits, and we're taking we've got a personal account, and we're taking $30,000-$40,000 out of that, and it's not costing us much in taxes." In fact, we're not paying any taxes.
Yeah, thanks to the the standard deduction.
$800,000 rollover from their company
that
they put away, and now it's been growing skipping last year. It was growing pretty well for a while, and maybe it's $1 million or more, and now they've got a $40,000 required minimum distribution or more
at age 73 or 70.
Whenever you have to take
whenever you take it, but it's for the first 8-9 years of their retirement,
zero tax.
And then all of a sudden, boom.
They're being taxes for the rest of their life. And when one of them passes away of that married couple, the taxes go up even further.
Yeah.
So the surviving spouse has less income because they lose one of the Social Security benefits and more expenses, a bigger tax bill. That's not a good recipe. That's an untasty recipe.
So if I'm trying to strategize and lower potentially my Social Security taxation, it's not a matter of, gee, I just retired 2 years ago, and I haven't been paying any taxes on my Social Security. I seem to be going along just fine. The thing that they need to be careful of, if I am understanding you properly because we've talked about this many times, but the thing they need to be careful of is this looming required minimum distribution with this gigantic, maybe, potentially, gigantic, IRA, 401k. Maybe they've had a 401k and they've left it alone, or they rolled it from a 401k to an IRA. But they have this required minimum distribution that's going to put a huge, gigantic...
Could have a big impact on your expenses. And I see taxes as an expense.
And throw their Social Security...
An untasty expense.
...into the taxable column. So what can someone do to avoid that? He asked in a leading manner.
Plan.
Yeah, which means...
You have to look into it and say, what is going to affect me? How is it going to affect me? And what can I do to change the effect that's expected to happen? How do I do something to make my position better?
Which maybe if you have a required minimum distribution age of age 73 and you retire at 63 or 64 and you start taking your Social Security, maybe that's a good time to start looking 10 years, 9 years, 8 years in advance. Is that correct?
And use all the tools that you can that are at your disposal. If you are charitably inclined, using qualified charitable distributions.
Get them out of your IRA.
Take it from the IRA. Just use what's available, but key there is you have to know what is available. You have to know how the incomes that you have are going to impact your Social Security. You have to know what things are available, like the QCD and things of that nature. How do you structure your financial income life to make a better picture for you?
So would you be looking at Roth conversions potentially Roth conversions from somebody.
I'm always looking for Roth conversions.
But anybody can convert.
And yes, you don't have to have a job to convert.
No limit to how much you can convert.
You can convert, and I've seen people convert I've seen people do $300,000-$500,000 of conversions in a given year, because they wanted to get everything to Roth. Now, I don't necessarily believe you need to get 100% of everything to a Roth, because
it's a lot of tax.
There is room to be able to take some amount of IRA distributions with your Social Security and still pay no income taxes. You can't be taking $50,000, $60,000, $70,000, but you can take 10, 15, depending upon what your Social Security looks like. So you don't have to go all the way to zero. But, if you had, $2 million in an IRA, million plus in an IRA, getting it down into the, the $500,000, $300,000 range, if you can do it efficiently before your Social Security hits, that can make some sense. But it depends on you. And I know I've seen it where people, this makes sense to do this $100,000 conversion, and you're going to have to pay $10,000 in tax on it, because you're going to get money from the bank to live on this year. You don't have any other incomes. You're going to be in a true 12% bracket after the deductions and everything. 10% for the first part, and they, but man, I just can't write that check. I just, you're going to write the check someday,
whether it's today or required minimum distribution age.
But doing withholding is easier than writing the check.
Oh, absolutely. Oh yeah, just give me the net. Give me the net
number, so I don't even know how much pain I was in.
Just tell me what I'm going to receive.
And so, you could do that with a conversion, a combination of withholding, and get a net converted amount and have that. So take 120,000 or 110,000 out of the IRA
and just say
100 into the account, into the Roth, and send 10 to the IRS as a prepayment.
Don't even look at it. Just
take your things to the accountant. I don't want to know. But I don't like doing that. I think it's interesting. I think everybody, when you have your taxes done, I think tax preparers should be required that when they give you back your tax return and say, okay, sign here and send it off, we'll do this. Oh, by the way, you need to sign it and acknowledge this is your total tax bill for this year. Now, you don't owe this. You get a refund this year, but your taxes that you had to pay this year was X amount of dollars to the feds and X to the state if you live in a state with an income tax. I think everybody should know what they paid in taxes every year.
Well, they can know.
It'll
they just
tick them off.
Well, they should. They can look. It's on everyone's tax return.
But you have to look through 20 lines of...
What line is it on for the federal? Do you know?
I think it's 17. I don't know. I'd have
All
to
right,
look.
but it's one of those. It says this is your total tax.
This is your total tax. And total tax includes lots of different things. The federal income tax, if you owe self-employment tax, it's on there. If you owe net investment income tax, it's there. There's all the little federal taxes that go into it. The additional Medicare tax, if you're paying that.
Well, it's funny because you don't think about it. You have your taxes withheld, so you generally just know what your net is. You don't really know how much you're owing. And the tax software, and I'm speaking of TurboTax, which I've used for many years now, I never actually even look at the form itself. I don't ever see the form. I just see the steps that are involved in getting the numbers onto the form. So I could not tell you. I don't look at my 1040 ever. I send it off electronically. I have to go in and tap and see where my 1040 is. I honestly don't ever look at the form. Remember, in the olden days, you actually wrote the numbers on the piece of paper. So
paper and pencil?
Yeah, you kind of knew that, but you just don't do that anymore. So, yeah, it's very difficult for anybody to know how much they're actually paying in taxes.
Right, unless you're sick like me and you actually look. But it is line 24, excuse me.
Oh, 24. All right.
Yeah.
So if you want to know how much you paid
in total federal taxes,
it's line 24 of your 1040.
That's what you owed, and most people have that paid for.
What's what you paid? It's not necessarily what you owed, right?
No, that's what you owed, and then you might get a refund because you overwithheld.
Well, that's what I mean. You didn't really owe it. That's how much you paid.
You paid it.
Yeah, you may not have owed that much because if you got a refund, you obviously didn't owe that much.
I didn't owe it in April, but I paid it through the year.
Right, and as it turned out, you overpaid. You didn't. You paid more than you owed.
Yeah, I don't pay any taxes. I got a refund. That doesn't mean you didn't pay any taxes. But I think it would be important. I think it would shock people in many respects to see and know what they actually paid in federal taxes and state income taxes. I mean, some people don't even know what their property taxes are because they have it impounded and it's just part of their mortgage payment.
Yeah. Keep your yo's to yourself. Yeah, that's me. It's you know, and I've always said that's one of the reasons they instituted the withholding for the taxes back in the 1940s, which was not to fund the war and all that stuff, although that was a good excuse. It's so that you will not know.
I think there's two reasons for withholding, and that is an important one. You don't know what you're paying, but the other one is how many people would actually have the money in April?
You wouldn't.
To pay the bill if they didn't do withholding.
Yeah, so it's a good idea, I suppose, but it also hides how much you're actually paying.
Oh, very much. Yeah, it's out of sight, out of mind. Kind of like, why does a 401k work as well as it does? Because it comes out of our check. We don't even know what's going in there.
And that's the good part of it. That's the forced savings part of it. But when it comes to taxes, and this is why when people don't pay attention to their taxes and they think, well, I'm not paying anything at all, and all of a sudden they get hit with the Social Security tax because they let their IRA get
out of control.
I hate to say that because we're talking about having a lot of money, and it's a good thing. It's too bad.
Wah.
Right, you got a big RMD, Cry Me a River. But why pay more than you have to? Hey, you said you've seen people convert $400,000 or $500,000 in 1 year. Is that? I mean, I guess
they had very large IRAs.
Well, that's true, but is that ever? I guess I don't want to say is that ever a good idea.
It was a great idea for them because it made them feel really good.
Yeah.
And there are times when that aspect of the decision making is more important than the pure financial.
And that's kind of ultimately what makes us decide whether or not we want to do anything with money. If it makes
the emotional side is the biggest decision making factor going.
I've seen people with 2.5% mortgages that say, I'm just going to pay it off. I got a big windfall. I'm just going to pay it off. And, well, you could do better than 2.5, can't you? That's cheap money. And they're like, no, I can't live with the mortgage.
Yeah, it's just a pain. I don't want to do it.
I just want to own it. And okay,
own it. There are worse things than having a free and clear house.
Well, there are worse things than having an estate tax. I would
like my kids to have to worry about having an estate problem.
Wouldn't that? I wish I had an estate tax problem.
Yeah. I've already given up on that aspect. But I'd really like to, have my kids.
Well, because you'll be living high off the hog, and that would be a good thing. That means you're worth, as a married person, over 26 some odd $million.
Good enough. I mean, hey, if I can get there.
Yeah.
And my kids would be, like, oh, darn, Dad left us with an estate tax problem. We'll cry all the way to the bank.
So to sum up this whole thing, to avoid paying taxes on your Social Security, you need to pay attention to what your other income is.
It's all about the other income.
Right. And for some people, they can't avoid it because maybe they've got just a large
their
pension.
Incomes are all fixed. I mean, they've got pensions. There's nothing they can do about it.
Or they're already required minimum distribution age, and it's too late. They have
at that point, though, if you're already required minimum distribution age and your Social Security is close to or at the 85% mark already,
then you may as well.
Now you have that true tax bracket again. How much more room do I have over and above the RMD in the bracket that I'm doing now?
Yeah, that's
because
true.
I'm going to be in that bracket forever. So I might as well use it, and maybe I can do conversions at that point, which will bring my required minimum distribution down in the future, which will definitely help the surviving spouse, hopefully many years in the future, so we don't have to deal with that. But there are reasons to continue doing Roth conversions even into your older ages.
So know what your other income is. And
sure.
The more you have in your Roth side, more the income comes from the Roth, and in some cases the personal side. But let's say the Roth, the less you have to worry about Social Security.
Qualified Roth distributions are easier to understand because they're tax-free.
Mm-hmm. Yeah.
Distributions from a personal account are more difficult to understand because what did that personal account earn? Yeah. Cash flow and taxability in a personal account don't go hand in hand. Taxability and cash flow from an IRA, you take cash flow out of an IRA, it's taxable. You take cash flow out of a distribution from your Roth IRA, qualified distribution, it's not taxable. With a personal account, whether I take a distribution or don't take the distribution has no impact on whether I'm going to be taxed on the earnings of that personal account or not. I mean, I could not take any money from the personal account and it earns interest. Got to pay taxes on it, even though I didn't spend it. It may have capital gains, may have capital losses, dividends. All those get taxed, whether I take a distribution or not. And so the outside, the traditional IRA, the Roth IRA, very easy to understand the taxability of. The personal account, how it's invested has a big impact on what is the taxability going to be from that account, regardless of whether you take any money from it. So we could be taking principal distributions, and that's not taxable.
Well,
so that's where the complexity of taxability comes in.
That's where a financial advisor can help.
Years like 2020, 2021, we had huge capital gains, lots of reinvested dividends and things in personal accounts. People's tax returns showed quite a bit of income, even though they didn't have any different cash flow. Then in 2022, their tax return looked very different than 2021 because there were no taxable distributions for them, or no reinvested
gains,
capital gains and things because we didn't have a whole lot of those.
Well, and as I was saying, this is where a financial advisor can really help out. People like you who just get so animated and excited.
So weird.
Even if we're, it just is. But people who understand this stuff, and the folks at Lucia Capital Group do this all the time, all year round. It's not just around tax time either. It's always a good idea to check and see where your income is coming from. If you've got Social Security benefits on the horizon, if you're taking them now, if you've got required minimum distributions looming in the future, it's a good idea to go over those and have somebody check and see, look, this is really going to hurt you tax-wise in about 6-7 years. Let's see if there's anything we can do about that now. Talk to the folks at Lucia Capital Group, 800-644-1150. 800-644-1150. The advisors, as I said, do this all the time. They work with Professor Plum, who oversees all the plans. Give them a call. Talk to them. Also, go to luciacap.com. You can find this information and much, much more. Great resources there, luciacap.com. Subscribe to our podcast. You better do it because you get content like this that you won't find anywhere else. Go to Spotify, go to iTunes. You can find us there and listen to this podcast every week. Professor, this has been fun. I know
taxes are fun.
I know that.
Who knew?
Well, I'll tell you what, next week, I don't know if it's next week, in the next episode or two, depending on what we're going to be talking about, I've got a thing on 3 generous tax benefits that you may not know about.
Oh, you're going to teach me something, John?
Not you, the people listening. No, you're going to...
I'd like to know about those 3 benefits.
I'll tell you. You know what they are. You know what they are. But I tried searching online for them, and all they want to talk about is tax deductions. Here, did you know this is deductible? I don't want to talk about that. I want to talk about how the tax code benefits us.
Yeah.
So,
and more people are not getting an itemized deduction. They're just sticking with the standard deduction because they don't have enough itemized deductions. Unless you're super charitable.
At least for the next year or two, and we'll see what happens.
We'll see what happens after 2025.
After 2025, yeah. All right, but anyway, that's for a future show. My thanks to Professor Rick Plum, and my thanks to all of you folks for listening. For Professor Plum, I'm your podcast host, Johnny Dean. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Municipal bond interest may be subject to the alternative minimum tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax.
Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Rick Plum, Joe P. Lucia, and Ara Friedman are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.